Folks, this is a presentation I've put together called a behind the scenes look at how I've created a 7-figure income selling options and how you can too. Now, I've got a lot of information, a lot of examples that are current. I've even got some stuff that my group and I have been putting together just last week. So I want to share that with you. So please get out some paper and pencil if you haven't got that out already. If you're feeling very confident this evening, get out a pen. But I want you to take some notes. Let's get right into it. First of all, I do want to throw this out there that there really is a lot of uncertainty with what's happening in the world right now, as you know. And what's happening in the markets, if you play it right, it will set you up for months, if not years to come. You got to remember this, right? Everybody's always talking about, $4.2 trillion was lost in the market today, or so. Money is not created or destroyed in the markets. It's simply moving from one person or entity's hands to another, right? The key is putting yourself on the right side of the transaction. Now, before I even get started, I do have the chat box open. One of the questions I have for you is, what are you looking for? Are you looking for how to invest for low risk and high return? In other words, learning how to fish, be 100% self-reliant? Or are you learning how to invest and have seasoned investors review your investments before you make them? In other words, you do want to learn how to fish, but you want to have some expert fishermen there to help. Maybe what you're trying to do is follow along with the seasoned investors and do what they do in their portfolio. In other words, you might want to be fishing alongside expert fishermen and do what they do. Or maybe it's something else altogether. I just want to get a good, okay, cool. I'm getting some different answers. It looks like for the people who are chatting in the chat box that it's kind of a mix of all over the board. That's great. I hope I have a little bit all for you to offer you here, but let's just keep it going. I do like to do this little scenario. You've probably seen this a bunch of times, but I just want to go through this math with you a little bit. If I gave you $50,000 today, would you rather take that, or would you take my other offer, which is a penny that doubles every day for a month? Which of those two would you take? Let's go through the math on the penny. So if I gave you a penny on day one, then that would turn into 2 pennies, 4 pennies, 8 pennies, 16, 32, 64. By the end of the first week, you have 64 cents to your name. Man, that $50,000 is looking pretty delicious already, isn't it? We're already about a quarter of the way through a month, if a month is about 4 weeks, and we've got 64 cents to $50,000. But let's keep going. All right. 10 days into the month, we're about a third of the way through the month. We have $5.12 versus 50 cents. By the way, we are having to put in some effort, right? We're having to double that penny every month versus just taking the 50, double our penny every day, but versus taking the $50,000. We're a third of the way through. Let's keep going. All right. By about the halfway mark, we have $163.84. All right. We're now about 3 weeks in, and at 3 weeks, almost 3/4 of the month has gone, and we're up to $10,485.76. Still not near the $50,000 mark. We're about 1/5 of the way there. All right. Day 22, day 23. Okay. Day 24. We are just now passing the $50,000 mark. And of course, as we finish out our month, you'll see that, again, the $50,000 was not the right answer. You do want to take that penny because at the end of the month, you'd have $21 million, $474,836.48, right? But I want to emphasize that if you didn't stick with it through the whole month, if you ended even 3 weeks into the month, the $50,000 would have been better. You have to be able to stay focused through the whole month of doing what you got to do, and realize that in the beginning, it may not seem worth it. After a whole week, we were rolling up at 64 cents, right? If you have what I call shiny object syndrome, where you can't stay focused, you need instant gratification, maybe investing is not for you, right? One thing that Albert, and again, I'm not sure if Albert Einstein actually said this, but this has been attributed to him. Compound interest is the most powerful force in the universe. And that's what I just sort of demonstrated with you. Now, this is a real world example. This is one of my premium selling trades where I sell options for income. And you can see that the income doesn't come linearly. It comes exponentially. Now, I'm going to explain this chart a little bit later in the presentation, but I do want to kind of tattoo this in your mind. In fact, I want you to notice where I'm placing some pen marks. This is your break-even mark right here. So very quickly into this process, you're above break-even. And then again, like I mentioned, I want you to just understand that these premium selling trades, just like the penny, they appreciate exponentially. You've got to leave your money in there and you've got to continue the process day by day by day. All right. So think about this. We're not going to be doubling there. You know, there's people out there who will say, oh, well, we've got investments that are going to double every day. I don't want to have you day trading. I don't want to have you married to the computer. In fact, that's kind of the worst thing. In 2005, I left. That was the last time I had a W-2 income, right? I left my job. And the last thing I want to do is create for myself another job, right? So day trading is not what I'm about. In fact, I'm all about investing, right? Kind of spending 20, 30 minutes per evening looking at the market, seeing what happened the day before, and then closing my computer and not opening it up until the next evening. I don't want to be glued to my computer, right? But one thing we can count on is doubling our money every year. Now, if you reverse engineer it, and don't even do it with compound interest, but do it with simple interest, if you reverse engineer what it would take to double your money every year, you'd have to earn 6% on your money every month. So I'm pulling back and I'm reverse engineering so that we have actual doable goals, not things that are going to happen just once in a while, but at the same time risking your whole portfolio. I'm talking about actual doable goals where we can count on doubling our money every year. So write down on your notes 6%. So that means if I have $1,000 this year, in 12 months, if I'm focusing on that 6%, $2,012. 2 years, I'd have $4,048. In 5 years, I'd have about $33,000. And in 10 years, I'd be a bona fide millionaire, starting with a $1,000 investment. But even better, if I had a $100,000 portfolio, which I would get very quickly in just a few years, then every year I would generate $101,219.65 per year. Now, the average mean income here in the United States, and I'm not counting you guys that live on the East or the West coasts where things could get a little bit pricey, but the average mean income, salaried income, is $87,000. So here you'd be living off your money, making more than the average income here in the States. You could live anywhere you want, right? Making more than the mean salaried income. And the best part about this is your money's working for you, right? Not you having to work 60 hours a week, because that's what comes with a mean income salaried job, is a 60-hour per week work week. So what are we actually investing in? Well, we are selling theta decay optimized option premium. That's a lot of words. In other words, we profit on time passing by. Remember, there's many ways that options profit, right? Options are not just directionally, right? Directional trading, when you think about stocks, commodities, Forex, crypto, selling real estate, selling baseball cards, selling antique cars or paintings, you're talking about things where you have to figure out the patterns of having prices go up or down, right? If you go long something, you're hoping that the price goes up. And if you go short something, price goes down. That's two different strategies to profit on price action. When you start bringing in options and futures, they're called derivatives, you now have up to 27 different ways. You can profit on price going up. You can profit on price going down. You can profit on price going sideways. But you could also profit on time passing by, as we're talking about here. You can also profit on whether the market is confident or fearful at the time, right? So options give you so much more flexibility. Instead of two ways, usually just one way to profit on something, you now have 27 different ways to profit on it. You just have to match the option trading strategy with the pattern you're seeing. So let me just ask you a quiz question to make sure you're paying attention. What minimum returns must we make monthly on our portfolio if we want to more than double our money annually? Was it 0.5%, 1.5%, 5%, 6%, or 10%? What was the number I gave you? So what our focus is on is D, 6%. Make sure you have that in your notes. And you might say, now people have been talking about options today. Aren't those things risky? And like I said, there's complexity. But if you just focus on one profit mechanism, options actually reduce risk, right? Because they allow us to profit not only if the market goes up, but also if it goes down, but especially if it goes sideways. We can profit on time passing by. And like I hinted at, we can profit on when the market is fearful or when the market is confident. Options give us 27 different ways to profit. Some people are like, can you explain what this option is? Sure. It's a derivative. They're typically bought and sold to hedge risk against stocks and indexes and ETFs. But what I'm doing with them is I'm selling their premium to generate income. Let me explain better. Let me first ask this question. Do you guys, how many of you with a show of hands, or just type into the chat box here, have you been familiar with me? Do you know who I am? AJ Brown. I've been around since Hammer was a hatchet. Okay, some of you are saying you do, some of you saying no. First of all, just you could take a screenshot or whatever. You can get a hold of me either on my YouTube channel, or you could subscribe to my weekly podcast. I've got Facebook, I got Twitter, I got articles, white papers. You can get in touch with me directly. You can even phone me if you want. If you do go to any of my social channels, do me a favor and hit the subscribe. I founded this company called Trading Trainer back in 2003. People often refer to me as the world's most disciplined option trader. I actually think behind my back, they refer to me as the world's most lazy option trader. I think it's because I'm very efficient. I don't like to waste any amount of my investment dollar, nor my time, which is, in my mind, something that I can't get back. Every day that goes by is a day that I'll never see again. So I'm very stingy with my time. I'm also very stingy with my feelings and emotions. I don't like to ride roller coasters. I don't like to go on highs, and I definitely don't like to go on lows. I've been doing this thing since 1997. I've published daily insights for my Trading Trainer participants every night, 5 days a week since 2002. And you might see on some people's computer this wildly successful ebook that I wrote almost 17 years ago called The 7 Strategies of Successful Option Traders. Or you might see on some successful traders' bookcases my home study course. And what I like to be known for is my foundation that I started, where I've taken, underprivileged or different types of communities. I've taken them off the streets and I've taught them how to invest. But right now, we had to take a break because, of course, the pandemic. But in 2019, we graduated over 4,000 inner city kids from Southside Chicago through my foundation, teaching them how to take care of their investing dollars, right? Stick it to the man instead of sticking it to each other is my motto, my kind of informal motto. But let's get back to the topic at hand. Just wanted to introduce myself a little bit. We focus on 4 simple transactions. Please grab your pencil for this. Number 1, We like to write covered calls. We like to write covered puts. We like, and if you haven't done covered puts before, we like to flip the covered calls upside down. We also like to write covered calls against leaps. In other words, we like to supercharge our covered call writing. We call this bull call diagonal debit spreads. If you're from kind of the academic, you're like, that seems like a bull call diagonal debit spread. You're absolutely right. We also like to write covered puts against leaps. This is supercharged covered put writing, bear put diagonal debit spreads if you're from the academic background. Now, I want to emphasize right now, and I'd like you to put like a sign, like maybe an asterisk next to covered calls against leaps, the bull call diagonal debit spreads, and the covered puts against leaps, the bear put diagonal debit spreads. Those are cash trades. And I like to highlight those right in the beginning, because those are ones you can do with any sort of account. You can even do them in your retirement accounts if you want to take advantage of tax benefits. Whereas this guy, covered puts, does require a margin account. And I haven't found yet where any broker offers like your Roth or your regular IRAs that can do margin. So keep that in mind. But it's nice because this particular guy right here is a variation. Let's see if I can pull up my pen. This bear put diagonal debit spread is a variation that behaves just like the covered put, but it is a cash variation. So if you're looking to do some of the stuff that the covered puts do, and you don't have a margin account or you're using a retirement account, well, there you go. You've got a variation you can tap into. So write down those 4 strategies. Now you might be saying, okay, you're getting ahead of yourself. What is option premium? All right. Well, every time you look up a price, right? Every time I pull down a trading application and I pull up the price of options, let's make this nice and big so you can see that. You've got this bid and this ask price, but you have to understand that this price, if you look at the mark, that's the halfway point, like $2.95 for that option. Part of that option is called the in the money value. If you're an academic, you would call that the intrinsic value. And the other part of that price is called the premium value. Again, an academic would call that the extrinsic value. Some people call that the time value. I hate that name just because there's a lot more into that component of the price than just time. But let's keep this all straight, right? Option price is always going to be the sum of these 2 values, the in the money value and the premium value. So what am I doing? I'm selling that premium component. Let's go through an example. This is an example on Ford. This is actually an example on Ford. I pulled all my prices. I put this presentation over the weekend. So these are going to be all with last weekend's prices. Here's Ford, the chart that we were just talking about. So over the weekend, Ford had closed at $19.50. Now, we could have gone ahead and sold the Ford December 17th $20 call. We would have made 86 cents. Now, that 86 cents automatically goes into our account and it discounts the Ford. It's now, if you look at the cost basis, our break-even price, it's not $19.50 anymore. It's much lower. It's 86 cents lower. It creates for us an instant dividend of about $86 per option contract sold. Option contracts are lots of 100 shares of the contract. So every time we sell a contract, we sell 100 shares of the option. So we get an $86 instant dividend when we sell that premium. So what happens if Ford closes above $20 on December 17th? All right, we paid $19.50 for Ford. If it closes above, we're going to get called out. We're going to get exercised and we're going to get $20. So we're going to make a 50-cent per share profit. We also get to keep the 86 cents for selling that premium, which give us a total of $1.36. That would be a 7.3% ROI. Remember, 6% in a month doubles our money every year. This is 7.3%. Now, what happens if Ford is flat by December 17th. This is actually the ideal case for us. You'll see why in a moment. But if we pay $19.50, we get the 86 cents. The 86 cents expires worthless. We don't get exercised. We don't get called out. We get to keep that 86 cents. That's a 4.6% ROI so far. And we get to do it again and again and again. But now here's where some people get worried. Again, this is just the covered call. It's a very simple variation of those 4 strategies. What if Ford drops? Well, I spent $19.50. I got my 86 cents, which dropped my break-even price down by 86 cents. That gave me a profit buffer of 86 cents per option share sold. Already, the stock would have to drop down below 1864 for me to have any sort of problems about going into the red. Now, I'm going to show you in a little bit how we can even hedge that even better. We can reduce our risk to nil using an additional strategy. But even now, built into the basic covered call, we have this profit buffer. So it's kind of good all around, right? Okay, so let me ask you another question. This is a question that's going to see if you're paying attention. Now, in this one, I want to answer, you can answer all that apply. So what does investing by selling premium create? An instant dividend, that's A discount on the security, whether it be an index, a stock, or an ETF. A profit buffer, does it act like an expiring coupon? Which is it? And it could be as many as you want. A, B, C, D, or it could be all of the above, or it could be A and B, B and C, C and D, A, B, C, B, C, D. Anyway, there's a bazillion combinations. What do you think? It turns out all 4 are the right answer. You get an instant dividend, you get the discount on the security profit buffer. I didn't really cover that it's an expiring coupon, but it does act like an expiring coupon, right? We get the money for it, and then as time goes by, it gets more worthless until it is worthless and we get to keep all the money. Here are some, I'm not going to spend much time on this, but here are some of the gains we've made on just covered calls. 17% on Micron, that was 12 trading days. That was when the stock was going up. 15% on Activision in 34 trading days. That's when the stock traded water. 14% on Allscripts Healthcare in 86 trading days. That's when the stock take a dump. That's because this strategy, again, doesn't really deal with the directional movement. It's all about time passing by. Now I'm going to ask you a question. These questions are going to get harder and harder. So if you thought those questions were easy in the beginning, they're going to get harder and harder. And now I'm going to start asking you questions moving forward to see if you know the answer in advance. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? There's only one answer. Should we sell out in time options? Should we replace the security, whether it's a stock, an index, or an ETF, with options trading at parity? Should we just give up? This is stupid. We should just buy mutual funds. Or is what I'm talking about not even possible? What do you think is the right answer? A, B, C, or D? Turns out the answer is we want to replace the stock, the ETF, the index. We're going to replace it with a substitute option trading at parity. For those of you that said A, we don't want to sell out in time options because it turns out that options have diminishing returns. In other words, unless you sell the near-term option, you're going to get into some issues with the amount of theta decay happening. In other words, the theta decay kicks in exponentially. The reason why that happens, by the way, is human nature. It turns out humans like to procrastinate across the board. It's not just your little ones who are waiting till the last day before their science project is due. Ask me how I know about that one. No, all humans like to wait. So what happens to the option prices? It's not until they get within the last month of expiration that people are like, oh crap, this thing is about to expire. and the value decays away exponentially. So if we go farther out in time, we actually put ourselves at more risk. No, what we want to do is replace that security. We want to find something that's cheaper and something that isn't a margin trade, and that's finding a substitute option. So you might be saying, now you said a term, options trading at parity. What does that mean? Well, option premium is the most when it's at the money. So when we sell our premium, we like to sell something that's close to at the money. But when we go very deep in the money, the option winds up losing its premium and it's almost completely intrinsic value. In fact, what we like to do is we like to target less than 5% premium. That means it's going to move just like the underlying security, dollar for dollar, only it's going to be at a cheaper price. Now, you might say, you're talking about an option, AJ. How far out in time should that thing expire? Options have expirations. I get it. We go very deep in the money. We make sure that it's mostly intrinsic value in the money value. But how far out? Well, it turns out that the folks in my program that I've been running since 2007, the average length of our trade is about 5 months. We collect 5 months of premiums over and over again. Now, some of us go as far as 8 months. I actually have a trade right now that's topping 14 months, but that's a very big outlier. Some go 8 months. Some even go just 3 or 4 months, but most of them go 5 months. We buy our back month options far enough out in time such that that option expiration is not going to interfere with selling many cycles of the premium. So specifically, we try to go about 8 months out or more. We like to use leaps. And the only reason why we like to use leaps is because they have a lot of option liquidity. They've been around for a while, but leaps aren't necessarily a requirement. In fact, here's an example. Let's go back to Ford. I could have paid $19.50 for a share of Ford stock this past weekend, or if I wanted to, I could go out to the June 17th, just on the edge of 8 months, $13 call, and I'd only pay $6.83. Now, that particular option has 95.2% of in the money value and only 4.7% of premium. So for the most part, when Ford goes up $1, that option's going to go up $1. Does that make sense? So let's run through that equation again. Instead of doing Ford, I'm going to pay $6.83 for this back month, deep in the money, far out in time call, the perfect substitute. And then, of course, I'll sell the front month option. This is called, by the way, a bull call diagonal debit spread. I'll sell that front month option for 86 cents, just like I did when I was just using the Ford stock. I'll create that instant dividend of $86. What happens if Ford closes above December 20th? Well, I paid $6.83 and I'm going to get $7 back. I get the difference between the $20 strike price of the option that I sold, this guy, and the $13 strike price. So that equals the $7. So I get $7 when I get exercised out. That's going to give me a 17-cent profit. But I also got the 86 cents for selling the option in the first place. So I get $1.03 per share profit, which comes out to 17.3% ROI. Remember, 6% ROI has me doubling my money every year. Think about 17.3%. That's why folks that trade with me in my program, we're actually doubling our money about every 5 to 6, maybe 7 months instead of every year, because even though we focus on getting 6% targets, we're making a lot more. Now, what happens if Ford is flat? Now, again, this is the ideal case because we get to do it over and over. I spent $6.83 on that back month option. I get my 86 cents for the front month option. The front month option expires worthless, so I get to keep that 86 cents. I've made 14.4% ROI so far, and I get to do it again and again and again. And of course, what if it goes down? I've got that 86-cent profit margin, profit buffer. I can go all the way down to $5.97 on that back month option. And again, I'm going to show you a method in order to hedge that even better. But still, built into the strategy, I can go all the way down and I still won't be in the red. Now, I want to remind you, actually, before I even do that, that's theoretical, right? That was using Ford just this past week. But what if I show you an actual trade? So let me show you Cisco. Cisco is a trade that I just did just in August and September. Really straightforward. Instead of buying Cisco, I bought the Cisco June 22 $40 call. I paid $16.66 per share. I bought 6 contracts, so that's 600 shares. I spent about 10 grand. On August 26th, I went ahead and sold my premium, $2.38. That was the September 17th $57 call. And I got $2.38 per share for that. Now, the scoop is on September 17th, I got exercised out. So I got to keep the difference between the $57 call and the $40 call. That's $17. When all was said and done, I walked away with 16.1% ROI. Not bad, just for a few days from August 19th. And then I wasn't doing any day trading. You can see here, I did one transaction on August 19th. A week later, I did another transaction. And then I just waited for the clock to run out. And on September 17th, it was payday, 16.1% ROI. None of this day trading stuff. I just do a couple transactions a week. Does that make sense? All right, let's get back. I want to make sure I cover all of this. We know that if we earn 6% on our money, our investment will double. Here's some of the examples that I've done with the substitution strategy. 21% on Caesars when the stock went up, 12% on St. Joe's when the stock treaded water, 17% on Community Health when the stock took a dump. All right, here's where we get into some fun. How can we drastically reduce our return on risk? Should we sell half as much option premium? Should we sell out in time options? Maybe we should collar the investment by marrying a protective option, or is what I'm talking about not even possible? What do you think? A, B, C, or D? This is the third most important layer of my strategy. If you said collar the investment by marrying a protective option, you're spot on. I'm bringing you back to this particular trade. This is a trade that I did on PAAS. And it shows this trade here. I'm going to come back and show you some of the credentials behind it. But first, I drew it up real nicely here. Here's that break-even line. What I want you to know is at 5 months is the average time these premium selling investments last. So I put that line right there. I want you to notice that if the trade gets returned by the position being exercised, we would log in a 65% ROI in 5 months on this particular trade. However, a lot of people always say, what happens if the trade goes against you? Well, if the trade goes against you, guess what? Instead of getting 65% ROI, I only get 50% ROI. There's not much difference. In other words, the beautiful part about these premium trades is even if the underlying symbol goes against your strategy, you still walk away with profit. In fact, after a couple months, the difference between the underlying going in your position and exercising you versus the underlying going against you becomes so small, it doesn't matter whether the underlying goes for you or against you. Does that make sense? In fact, notice it only takes 1 month. So you only have your invested dollar at risk for about the first month. And then after that, it's called a risk-free trade. Here, let's take a look here. This is PAAS. Now, I want you to take a look at this column over here because this trade's been going on for a hot minute. This actually started, and you can see here, we've got it going all the way up through October of this year. So this trade's been going on for 14 plus months. But I spent $34.74. I actually spent $34.73, but this particular spreadsheet is taking into consideration the commissions I pay. So $34.74 per share. I sold my premium, but then notice I bought a protective put. And when I bought that protective put, I spent $4.75. In other words, I actually spent a hot dollar, and I selected that protective put quite strategically. Write this down. 3 to 6 months out, and I want to pick the strike price down at my stop loss order. So in this case, and you want to put on the protective put the minute you sell your premium. So you'll notice that when I sold my premium, I immediately put the protective put on, right? Here's what happens. The premium winds up expiring worthless like this one did. And then we sell back the protective put because we don't need it anymore when the premium expires. We basically roll it out to the next month and we sell it back when it's no longer needed for protection. And we tend to always get a profit. So in other words, not only did I make $1.76 on selling the premium, but the frosting on the cake is that it looks like I also made another dollar, what is it, $1.15 rolling out my insurance, my protective option, my married collared protective option. I did it again. I sold premium the next month for $1.47. I bought my protective option for $3 and a penny. The premium expired worthless, and I got to sell back the protective option for $3.62. Here is a case where I made $1.47 on selling the premium. I made another 61 cents on rolling out the protective option. I did it again. $1.50 selling the premium. $1.20 is what I paid for the protective option. The premium expired worthless, meaning I get to keep the $1.50. And when I sold back the protective option, this is where the underlying symbol actually took a little bit of a nosedive. I made more by selling back my protective option. In this case, I made $1.50 here, and I made $1.77, maybe even $1.87 now that I'm looking at it here. Does that make sense? So this is quite different than most people who are selling covered call writing education, right? Most people hedge their positions with something that we call a loss leader, right? Instead of being a profit center, it's a loss center. It just serves as protection. What we like to do is we like to hedge our investment with positions that can actually appreciate. So not only are they protecting us, but they also give us a little added, we call that a profit center to our economics of our trade. So we kind of put a spin on it, and it's been quite useful for us because not only do we make money on the premium, but we also make money on the protection. That's why we get kind of the numbers we're talking about. Let's keep going here on our presentation. Let me also point out one other thing. I got to show you one other thing here. Now, notice right here, we're using the $34 put as our protection. After the first month, you'll notice our break-even price dipped down to $31.86. Think about that. If we're protecting our position $34 and lower, if our insurance policy kicks in at $34, but at this point we only have $31.86 in our trade, what does that mean? What does it mean when you're insured for more than you bought the property for? Think about that. Let's keep going. So what do we have when our cost basis or our break-even price is less than our protective bailout price? Do we have a risk-free investment? Do we have a losing trade? Do we have too much complexity? Do we have a pipe dream? Which is it you think? A, B, C, or D? Absolutely. At this point, you have a risk-free trade. And again, some of you are saying, gosh, this is really complex. Is it really though? Listen, I do a trade on August 26th. On September 1st, I do a premium selling trade and I buy protection. And then I wait till September 18th, it expires worthless, and then I sell back my premium. It's not like I'm doing a ton of transactions every day. In fact, if I'm doing one transaction a week, that's a lot, right? October 1st, I do some trades. Then October 16th, things expire automatically. I don't have to do anything there. It just expires. I get to keep the money. It's a paycheck day. Every third Friday of the month is the paycheck day for me. Third Friday of the month is when monthly options expire. Then I sell back my protection. I roll it out for the next month. November 6th, I buy it again. It's not like this is super complex. I'm doing like one transaction a week. Some of the strategies that you've heard today are people like trading 3 or 4 times a day. What you've got here is a risk-free investment. Cool. So let's review the 3 steps. Let's make it really easy for you. Buy or short an underlying security. Or instead, you could buy a substitute option that's trading at parity. Then you sell a near-term at-the-money option for its premium value. You collect the instant dividend and you set up the profit buffer. Finally, you collar with a married option that is 3 to 6 months out in expiration to protect your investment. That's it. That's all I'm doing. And I'm just repeating steps 2 and 3, 2 and 3, 2 and 3 until I get exercised. Now, we like to find sideways channeling symbols, right? The way that Ford has set up over the last week is perfect for us. When you have a sideways channel, you could leg in. You'll notice that I use different dates. In a covered call, this is how it looks. When we're at a low, and it doesn't have to be the bottom. You don't have to hit the bottom perfectly, but when we're at a low, we like to buy our underlying, or we buy that call option trading at parity. We put in place our bailout order. Then when we're at the top, and again, it doesn't have to be the tippy top, we sell the near-term call option and buy our protective put option. The near-term call option expires worthless, and we sell back that protective put option. And then we rinse and repeat, rinse and repeat, rinse and repeat. It's the same thing. I've been doing the same thing since 1997. If you're doing the covered put, you start at the top instead of the bottom. That's the only difference. So if the underlying symbol is at the top, then you short the underlying symbol. Or if you want to make a cash trade out of it, buy your put option trading at parity. Place a stop loss order, of course. Then at the bottom, you sell your near-term put option and buy your 3 to 6 month out call option as protection. When option expiration rolls around, that near-term put option will expire worthless. You sell back your protective call, rinse and repeat, rinse and repeat, rinse and repeat. So at this point, I got to ask you, how would you like to never miss a pick? Because I've got some screeners that help us find these things. Minimize the amount of time you spend away from your loved ones or your loved projects. I seem to have taken on a lot of cool projects since the pandemic started. I've got all sorts of things out in the workshop and here in the home. And how would you like to have support in doing this whenever you need it? Because that's really what it's all about, isn't it? It's all about saving time. Again, time is my favorite thing, right? You can't get back the day that just went by. Creating clarity so that you're crystal clear on what you're doing and getting results. So my question is would it be okay if I take just a couple of moments at the end of this presentation, just to tell you a little bit about my materials, my training and tools just to see if they might be a match for you. A lot of yeses showing up in the chat box. Thank you. This is for someone, by the way, you can take all the stuff that I just shared for you and you can go check it out. Pull up your trading platform, whatever it might be. I got this one off of Ameritrade that's called Thinkorswim, but you could use whatever you want. Just have your option chain available. If you don't have a trading platform through your broker, you can use a free charting software on the web and then also go just to the cboe.com and look up these option chains. You can get all this information for free. See if what I'm talking about, do some back testing. But if you want to do it with us, this is for someone who really doesn't want to pay for a bunch of different data subscriptions to different tools. They want everything that they need in one place. They don't want to miss any opportunities. They don't want to spend more time, or they do want to spend more time doing other things than just staring at their computer screen. They don't want to do this alone, and they do want step-by-step instructions. This is for someone who wants to get consistent, reliable results. Like Charlene. Charlene started with me almost, gosh, we were still back in the other office. So quite a few years ago. This is something she wrote to me back in the morning. I wanted to take this opportunity to tell you my story about how I used the instant income calendar tool. She had been a teacher for 29 years. She got sick. It was cancer. She was ordered out of the classroom with 13 years left before she could get her full retirement through the school system. She thought she was going to pass away, and she actually came to some peace about that, but then had a recovery, which sadly here in the States, I don't know how many of you are here in the States, but because of the way that our health system is, man, what do you, after you have a miraculous recovery, what are you left with? Hospital bills. And especially if it's one of those debilitating diseases where you can't, like, you're too weak to go back to work, right? She had no livable retirement coming in. She wasn't able to collect her Social Security for 10 more years. She did get interested in the stock market. She found me on the internet. Not only is she making a living, she's now able to travel. What can be better than that? She said the instant income calendar tool is very easy to use. All you do is read the daily table, find the stock you're interested in, follow the strategy set out for you. I use this along with other strategies to diversify my financial plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. It was easy. So that's kind of the real nuts and bolts. So let me show you just around. When you're part of the program that we have, it's all about, we give you access to this web portal. This is the web portal that you get. In fact, we're having one of our weekly workshops in an hour and 10 minutes. These weekly workshops are pretty fantastic. Right now, we have about 400 active members of our program. On any one of these Thursday evenings, we'll have about 100 people show up, and they throw tickers at me and one other coach of mine, and we go through them. They are pre-vetted tickers, and we find one that is the best of the best, the lowest hanging fruit. And then we go ahead and plan it out. In fact, here's an example of one. This is from 2 weeks ago. This is from November 4th. This is ticker CNP. Let me pull it up for you. You might want to write that ticker down to go look on your own. We give everybody this cool planning worksheet. Here's CNP. Centerpoint Energy Incorporated. We give people this cool planning worksheet, and we fill it out together, all online. It's an interactive workshop. We fill out where we think support and resistance is. It's just a couple of questions. We fill out all the yellow blanks, and guess what? This worksheet creates for us a plan. Each of those strategies that I laid out for you. If you want to write a covered call, you, after the bottom is found, go long 600 shares of CNP. Make sure you pay less than $25.54. Put a stop loss order. Step 2, after the top is found, write 6 contracts of the near term at the money call, and also buy 3 to 6 month out $24 puts as protection, right? If you want to do the covered put, it's got the plan for the covered put. It's got the plan for doing the bull call diagonal debit spread. In other words, we've really narrowed it down to just simplicity. And we do this worksheet together on Thursday evenings. And then folks go off and do these trades by following the plan. Also, what we do besides the Thursday workshops is once a month, we have these cool lecture series where I do a deep dive into this process. I also can't forget about the screeners. We have these different screeners. Here's the screener. Let's see if it's run for this evening already. I'm going to click on Premium Selling Screener. I'm just watching my time. I want to make sure, besides just showing you around this program. All right, take your time. It knew that I was, okay, here's this. This is the screener from last evening. The screener runs every evening, and these are just symbols that would be worth checking out. And it tells you, you know, buy this stock, sell this call, buy this put, and all the different returns that are capable. So we have a screener. In fact, we have a couple of beta screeners, beta 1 and beta 2. So that's part of the program. And here's probably the best part of the program. And I also forgot, of course, there's tutorials on how to do all of this, a couple of minutes of watching some videos. But the other thing that's really cool is when people want me to look over their shoulder. It's called trading questions. And I've got 3 minutes left, so I'm going to go fast here. But people will attach their trading worksheets. They'll attach screenshots and they'll send them to me. This is built into that program. They'll send it to me and I'll look over their shoulders and I'll tell them what they might be missing, what they're not missing, and what they need to look out for, what they might have to modify their plan, et cetera, et cetera. So I don't leave people out in the, out in the dust. I actually interact with quite a few people every day to make sure that their plans are spot on. So one of the questions is you got the video tutorials, the live classes, the screeners, the planning tools, the weekly live workshops, the interactive workshops. Everything has replays, the trade review. What is that all worth to you? I also have a double your money back guarantee. So I want you to do the program for 6 months. I want you to do this program for 6 months because that's how you're going to get good at it. And after 6 months, you don't have a profit. Not only will I give you the money you paid for the program back, but I will also double that. And that's how confident I am about this program, that you will show a profit if you stick with it for 6 months. Also, I want to give you a strategy session as a bonus as being part of this Friendsgiving program. So this is where I'm going to put you online with somebody and they're going to ask you where you are right now and where you want to be. And they're going to help you navigate a plan from point A to point B so that you have milestones along the 6-month program. So now, including the double your money back guarantee and the bonus strategy session, what is all that worth to you? What is it worth to you? $597 is our going price. That's a flat fee. There's not going to be any other charges. 6 months of access to the program, 6 months of access to the replays, 6 months of coming to the Thursday workshop, sending me your trades so that I can review them, all of that good stuff. And since you're part of this Friendsgiving, forget about the $597. I want to make it for this evening, $497. Now, how do you take advantage of that? You go to optioninvesting.org/Friendsgiving. In fact, let me test that to make sure that URL works. If you have a phone, you should be able to scan that QR code. So sure enough, if you go to optioninvesting.org/Friendsgiving, you should come here. And there's a place for you to put a promo code. And the promo code that I want you to put to reduce the price by is 100 DISC. Make sure it's all capitals. Let's test it out. I want to just make sure this works. I want to make sure. Where is it? Nope. There it is. Let's type in 100 capital D, capital I, capital S, capital C. Click apply. Sure enough, it reduces it by $100. So put in that promo code and you're good to go. 100 disc. Yeah. And I saw that they just put that link up in the chat box. You can also, if you are having troubles with any of that order form, you can call us. That's our phone number, 970-266-8146. We'll take your order over the phone. There's the 6-month program, just in case. That's for learning to fish. We also have people stay on past the 6 months because they like how we help them to fish. We also have a trade with us type program that we ask that you go through the 6-month program first before we tell you about trade with us, but you can join our trading group and trade with us and just look over our shoulder. So yeah, there you go. Optioninvesting.org/Friendsgiving, promo code 100 disc. Telephone orders, you've got that. Don't pass go. Don't collect $200. You deserve it. And your loved ones deserve it too. David, thank you for all your effort in putting together today's presentations, man. That's awesome.
Yeah, thanks for being here. Great presentation. So
thank you.
Great way to close out the day.